Good morning, everybody. Welcome to our LBTT and ADS residential update. But we're delighted to be talking to you today about LBTT and ADS. And it's a residential update. So we're concentrating on residential matters. My name's Isobel. I'm Director of Corporate Tax here at Brodie's, and my colleague Bob Langridge, who's a Senior Associate in the Corporate Tax team, will be joining us. Well, has already joined us and will be speaking, I mean. The agenda for this morning is to talk about how many dwellings there are involved in a transaction and how that affects the LBTT and ADS. Then residential and non-residential property, which is an enormously important issue. What can we learn from recent tax cases? An update on Revenue Scotland's guidance on debtors' consideration and some ADS elephant traps and how to try and avoid them. So first of all, some points from me on how many dwellings are involved in a transaction. And why does it matter? So this is a bit of a salutary example of Mr. A buying a house in the new town in Edinburgh for £1 million, and he pays the ADS, the LBTT of 78,350. There's no ADS because although he owns other properties, he's replacing his main residence. But some months later, it comes to light that the basement of this Newtown property is in fact an entirely separate dwelling. And this was let out by the previous owners in the past, and Mr. A, in fact, is going to let it out himself. This means that he didn't buy one house, he bought two. And so there's ADS on the basement, and he faces an ADS charge of £8,000 plus interest and penalties. So that is not a good place to be. However, because the purchase involves two dwellings, a claim for multiple dwellings relief can be made. And that actually gives an overall tax saving, even taking the ADS into account. So that was a narrow escape. But arising from the fact that there's actually two dwellings and not one. The question of there being more than one dwelling comes up with basements, as we've seen, and also with annexes. And the real question is whether the extra space, the extra area, is sufficient for somebody who's unconnected to the buyer to live in independently. So could it be, for example, let to an independent family to live in? The test for whether something is a dwelling is whether it's used or suitable for use as a dwelling. And the used test takes priority. So if something's being used as a dwelling at the time of purchase, then that pretty much clinches the deal. So if that basement flat had actually been let out to an independent family at the time of purchase, then it pretty much would mean that that definitely was a dwelling. But if there isn't that use, then the next test is suitable for use. And suitable for use depends on the physical configuration of the dwelling, whether there's independent access. So with a basement, is there access from the rest of the house? There needs to be privacy. Lockable doors. The extra dwelling needs to have sleeping accommodation, living accommodation, bathroom and kitchen areas. For the kitchen, there doesn't necessarily need to be all the white goods and so on that you would need, but there needs to be plumbing and so on for a sink and power for the cooker and so on, so that you could actually use it as a kitchen. And some of the recent tax tribunal cases have been about the insufficiency of things in the kitchen area to be able to actually operate it as a kitchen. There are lots of other tests that come into play, whether the utilities can be separately controlled, whether the council tax treatment is separate, but those are not necessarily conclusive. There is some fairly detailed HMRC guidance on whether only one dwelling has been purchased or two, so whether there is a separate dwelling, but the facts all need to be weighed in the balance. And as I say, it comes down to whether somebody independent could live there. There are a lot of situations where there might be a dwelling inside another property, like a flat in a pub or something like that. And it's the degree of independence that's really offered by the separate dwelling that's important. With annexes, it's a fairly high bar if you are trying to argue that an annex is a separate dwelling. And some of the recent tax cases have been lost on the basis of there being a corridor separating the annex, for example, from the rest of the house, but no actual door that's lockable between the two. So in that case, it wasn't held to be a separate dwelling. And there's also concern about access across through the garden or through a garage or something like that. So it's a very high bar, but it is important to consider how many dwellings there are. Moving on, we've mentioned multiple dwellings relief and how this can be a help in these situations where there's more than one dwelling. So if you buy two or more dwellings in a single transaction or linked transactions, then you can claim multiples dwellings relief. And this means that you pay LBTT on the average consideration for each dwelling, with a sort of minimum cap that the LBTT can't be less than 25% of the tax attributable to the dwellings without the relief. If MDR is claimed, ADS is payable on the average consideration. So in the case that we talked about earlier, where the house was being bought for £1 million, the main house 800,000, the basement flat 200,000, the tax as we on the house is 78,350 and the ADS 8,000. So the total tax is 86,350. If we claim MDR, we can't get an answer that's less than 25% of the total tax, which is 21,588. But looking at the example, the average price for the two houses is 500,000. The LBTT on the average price is 23,350, so that gives you 46,700. And then ADS, when you're doing multiple dwellings relief claim, the ADS is payable on the average price. But even so, there's a saving of 17,550 as compared with the amount of tax with no MDR claim. So MDR can give a significant saving, and that's why in many cases people try to argue that an annex is a separate dwelling in its own right, so as to give rise to the MDR claim. Now, if you are buying 6 or more dwellings in a single transaction, the whole thing is subject to the non-residential rates. It's treated as a non-residential purchase and no ADS is payable. So that's obviously a very valuable position to be in. But what is a single transaction for these purposes? Well, there needs to be a single set of missives or some kind of overarching agreement. There isn't a definition in the legislation, by the way, as to what a single transaction is for the 6+ rule. It can't be different purchasers, but it can be more than one seller if the contractual arrangements are along the same lines. The purchases can complete at different times. It doesn't have to be a single interest in land. It can actually be separate title numbers, so that doesn't matter. But it needs to be generally the same seller and purchaser or parties connected with them, but it can sometimes be more than one seller if that works out in terms of the contract. A single transaction is probably narrower than just a single deal, because a deal could span various different transactions. But to get into the 6+ rule, it's different from being in linked transactions. It's a much narrower thing. For the 6+ rule, it's not a portfolio test either. You can't buy 5 now and then 1 later. It has to be all as part of a single transaction. Linked transactions, however, are a bit more spread out, as it were. They're linked if they form part of a single scheme arrangement or series of transactions between the same buyer and seller or persons connected with them. So here you might have heads of terms which refer to several different transactions or pipeline of transactions, or an agreement that a total number of properties will be bought over a year or something like that. What's the good thing about linked transactions from the LBTT point of view? If linked transactions include a non-residential property, LBTT is payable on all the transactions at the non-residential rates. So the linkage of residential and non-residential makes the whole linked transactions non-residential. Also, as we've mentioned, multiple dwellings relief can be claimed across linked transactions. So if you have 2 or more dwellings in linked transactions, you can claim the multiple dwellings relief on those dwellings. But the 6+ rule doesn't apply to linked transactions, only to purchases in a single transaction. So there is quite a difference between single transaction and linked transaction. There are also differences on when things might be substantially performed, because a single transaction, once you've got sort of 50% of the consideration, that will be substantial performance. Whereas with linked transactions, you have to look at each one on its own merits to decide whether it's been substantially performed or not. Okay, I'm going to hand over now to Bob to talk about residential and non-residential property and what we can learn from recent tax cases.
Morning all. So in this section of the talk, I'm going to go through a number of recent tribunal cases, mostly SDLT rather than LBTT, looking at the definition of residential property. I'll come on to kind of few overarching themes in a minute, but for now, the key thing I want to do is really just flag up that I think it's okay to look across SDLT and LBTT here, because the definitions in Section 116 of Finance Act 2003 and Section 59 of the LBTT Act are effectively identical. You can see them on the screen here. Residential property means a building that is used or suitable for use as a dwelling, together with the land that forms part of the garden or grounds of a building, or an interest or right in land that subsists for the benefit of a building. And non-residential property in both cases is simply defined by exclusion. So anything that isn't residential is non-residential. The cases we're going to be looking at really concern leg B in both definitions, and that is where you are buying a house that comes with a substantial amount of land or other buildings. When does that land fall to be treated as garden and grounds of the dwelling and therefore residential, as opposed to something else, a non-residential? Now, quick disclaimer, in fact, 2 quick disclaimers and a little warning. Disclaimer number 1, all of these cases are very fact specific, and the reasons for that will kind of become clear as we go. But the first part of this is that of course, getting your facts right if you are arguing residential or non-residential issues with Revenue Scotland or indeed HMRC is really, really important. And indeed, a number of these cases seem to have failed because the taxpayers were not arguing well with the facts that they had. Secondly, the majority of these cases are first-tier tribunal cases, which means they are non-binding. There is one upper-tier tribunal case in the mix, which is in fact a combined appeal against all three of them, which is binding, but is quite narrow in its scope. What I would say, though, is that's not necessarily doesn't necessarily mean that these cases are uninteresting to us, even though they aren't binding. They are still informative. There is cross discussion of them between the cases, and there is a common, I would say, direction of travel and theme that emerges from them. The wee warning then, quickly, is that most, in fact, all bar one of these cases is triggered by a taxpayer paying tax at the residential rates and then trying to amend their return or claim overpayment relief to justify a move to the non-residential rates. So a sort of cynical lesson there is it's better to get it right first time because you're less likely to be in a debate with the revenue rather than trying to revise the position further down the line. The first case I want to mention then is Hyman against HMRC. This is a 2019 case that concerned the purchase of a substantial country house with 3.5 acres of ground. There was also a rundown barn and an adjacent meadow, which was included in the purchase and which was separated from the house by a bridleway. This is one of the overpayment relief claims. Ultimately, HMRC were successful in arguing that this entire transaction taken together was residential. In other words, that the barn, the 3.5 acres, and the meadows were part of the garden and grounds. The tribunal here said a few interesting things in coming to side with HMRC. First of all, garden and grounds have their ordinary meaning, and grounds is a wider concept than gardens, otherwise it wouldn't be here. The tribunal tries to sort of define grounds a bit as land which are attached to or surrounding a house and which is occupied with the house. And it's clear that it doesn't need to be used in a specific way to be grounds. You know, the tribunal says you could leave ground to become overgrown, but if it is occupied with the house, then it is still grounds of the house. Next case, and this one is a bit of a shocker, and it's a shocker for two reasons. First of all, it is the purchase of an actual farm, including 27 acres of fields, over which there was a grazing license with an adjacent farmer. And secondly, this is not an overpayment case, and this is Pensfold against HMRC. In fact, the property they bought was called Pensfold Farm, so one can only imagine that there was a tax return that went in the name of Pensfold Farm, and HMRC decided to inquire and challenge against it. This is a salutary lesson in getting your facts right and getting your facts early, because the only bit of this case really concerning whether the property was residential or non-residential was confined to an argument about the nature of the grazing license. And HMRC were successful in this because the appellants, the taxpayer, weren't able to satisfy the tribunal that the grazing license kind of broke the relationship between the house and the land, so that the land wasn't purely there to be occupied with the house. The next case, Goodfellow against HMRC. And this is the purchase of 4.5 acres of land with a large house, a swimming pool, a home office above a garage, as well as paddocks and a stable yard, which were used to home horses. Another overpayment case and another win for HMRC. The key thing that really emerges from the decision in this case is the importance of context. And what the tribunal did here was that they looked at the nature of the house and they classified it as an equestrian property. And they really hinged their decision on that characterization. You know, they went on to say, looking at the character of this house as a whole, all of this land surrounding it is very much essential to the character of that house. It protects its privacy and its peace and its sense of space, and it enables enjoyment of typical country pursuits such as horse riding. And they even went a bit further than this. You know, they said that if the house was sold without the paddocks and the stable yard, it would lose its essential character as an equestrian property. So in deciding whether all of this land and the paddocks and the stable that came with the house was residential or not, the tribunal was really informed by the character of the house that was being bought and was at the center of this. The next case then is the appeal case, and this is a combined appeal of Goodfellow, Hyman and Pensfold against HMRC. And the first thing to note about this is it is quite a narrow decision. It is not perhaps as healthful as you would like. Reading it, I think the barrister who was acting, who didn't act in any of the original cases, probably did the best job they could in arguing this. And particularly with Pensfold, I feel it's an unfortunate decision because HMRC were successful in upholding all of these properties as residential. And what this underscores with Pensfold is that you have to get things right at the first tier tribunal when you're arguing something very fact specific, because the first tier tribunal is the arbiter of facts. And so it wasn't open to counsel in this appeal to bring up additional factors about the nature of the property in Pensfold that would have pointed it to it being residential. They were confined to arguing on points of law. What they tried to argue, based on the sort of derivation of the SDLT legislation and some historical HMRC guidance, was that to be garden and grounds, bits of land purchased with a house, it wasn't just enough that you bought them with a house, it was that they had to be required or necessary for the reasonable enjoyment of the dwelling. Some of you will recognize that concept of reasonable enjoyment from capital gains tax, because if you are selling a house with a large plot of land, principal private residence relief is only available on a permitted area, which is half a hectare or whatever is reasonably required. The tribunal were quite clear that there was no need for reasonable enjoyment with the land. So this concept of garden and grounds is therefore wider than the equivalent capital gains tax concept of a permitted area. Next slide. Again, Miles Till against HMRC, quite similar to Goodfellow, purchase of a house with a paddock that was used for horses. HMRC were successful in arguing that this paddock was garden and grounds, and therefore it was residential. And the reason I bring this case up is because I think one of the key themes from these cases is well articulated here. And the central issue that the tribunal looked at was, does this paddock have a self-standing function as opposed to being a functional appendage of the house? And that concept is really, really important in the next case we'll look at, which is SLOSS against Revenue Scotland. And this is the biggie for a number of reasons. First of all, it has the best facts. We're dealing with close to 70 acres. Second of all, it is an LBTT case, so of interest to us all. And third, the taxpayer won. And it's really the only case we're looking at today where the taxpayer did win. In SLOSS, there are a number of things going on in the decision, but for our current purposes, it's just interesting to look at how the taxpayer was successful here. First of all, really in line with Miles Till and some of the comments from the other cases, they successfully argued that there has to be a functional relationship between the dwellings and the land that is bought with them for them to constitute garden and grounds. And they successfully used the kind of context argument that came up in Goodfellow, and to argue that some of this land just isn't essential to the house. And it, you know, the size and nature of this house, you wouldn't expect it to come with extensive grounds. They don't have that functional relationship to a house of this nature. For example, Revenue Scotland tried to argue that the view of the fields added to the sense of space and calm of the house. But the tribunal held, well, that doesn't matter. You can't see some of these fields from the house, so they don't have that relationship to the property. The revenue also tried to argue that as a country house, it was important to have this kind of land to walk and roam in. And that's what you got from it. And the tribunal, being incredibly bullish, said, well, no, that's irrelevant, because you could walk in that land whether you owned it or not, under the right to roam, under the Land Reform Scotland Act. So that doesn't matter. And they also, and this I thought was very interesting, held that although the land was grazed by a neighboring farmer, the fact that there was no formal grazing license in place and no cash payments was irrelevant, because a normal revenue line is you have to use land commercially to stop it being residential, and you have to exploit it for profit. And the tribunal here held the fact that, well, even though there's no profit and there's no formal agreement, this land is grazed, and this grazing arrangement is commercial because it's mutually beneficial to both parties, and that's enough. And so in this case, they were successful in arguing that some of these fields, not all of them, were non-residential, and therefore the entire transaction was non-residential. Final case I want to look at, another downer, and this is Brand Bros against HMRC, which came out earlier this year. It's the only one which isn't a sort of rural property, but it's interesting because it touches on that question of what kind of use of a bit of land is enough to stop it being residential. The facts here are quite odd. You know, someone was clearly trying to structure things in an aggressive way. The buyer purchased a house and garage and granted a lease of the garage to a third party for use as commercial storage on the same day as the purchase completed. But crucially, the lease was granted by the buyer and not the seller. And the actual occupation of the garage as a commercial storage unit didn't start until later. So the taxpayer tried to argue, well, this is non-residential because at the effective date, there was a non-residential use, a commercial use of the garage. And the tribunal did not accept that argument. They held, first of all, SDLT, LBTT, they're transactional taxes, so you have to look at what was acquired in the transaction. Even though this lease happened on the effective date, it happened after the transaction occurred, so it didn't change the nature of the transaction itself. Secondly, they held that the grant of the lease in and of itself did not change the nature of the property to make it mixed or non-residential. They didn't say what would have changed the use, so they were silent on whether the tenant actually taking occupation and using the garage would have been sufficient. But it does show that you do have to potentially push a bit further than a sort of sticking plaster approach. What conclusions would I draw from this? First of all, mixed property is very fact specific, and there are as of yet no general rules about, for example, what acreage pushes something into non-residential. And I doubt that there will be, because clearly context is incredibly important here. You have to look at the actual dwelling, the actual houses at the center of this, and establish what the relationship of the land to that house is. And there has to be an element of connection or a functional relationship between the land and the dwelling. That functional relationship is not as high as reasonable enjoyment, but if you can provide evidence of some other use or purpose behind the land, that's probably enough to break the idea that there is a functional relationship. You could also argue that there just isn't one, which seemed to be part of the decision in SLOSS. But ultimately, I think the direction of these travel in these cases is helpful, because it shows that the sort of standard revenue view that land needs to be occupied for commercial purposes and exploited for profit to be non-residential is wrong, because none of the tribunals in any of those cases adopted that position. Okay, quick update from Isobel on debtors' consideration.
Thanks, Bob. And just a reminder that if you have any questions, please put them into the Q&A box at the bottom of the screen and we'll pick them up later. So debtors' consideration, as I'm sure people are aware, the assumption of debt as part of a transaction can count as consideration for LBTT purposes. And Revenue Scotland have recently updated their guidance on debtors consideration in the LBTT manual paragraph 2003. And what they've really done is set out with a bit more clarity when debt is assumed. So on the next slide, you can see that they're now saying if debt is assumed where there is an agreement between two or more people whereby one of them agreed to be liable for an existing debt when they were not previously liable for it, or one party indemnifies another for any liability the other party has in relation to a debt. So that's really making it clear that it's not just a question of debt sort of being treated as being assumed by another party. There has to be something express to mean that the debt is treated as consideration. And there's three examples that sort of hang off this bit of the guidance, which pad this out a bit more. So this new guidance is really worth looking at if you're involved in any of these situations where people are gifting properties, where there is mortgage debt, or husbands and wives transferring shares of properties between them to get the benefit of income tax treatment, which splits rental income and things of that nature. So it's just making it clearer that there's got to be an actual agreement to assume debt, not just that debt is automatically treated as being assumed. Okay, moving on to some ADS elephant traps. And first of all, a quick recap on some of the overall ADS points. ADS is payable if the chargeable consideration for dwellings is more than 40k. So if you're paying more than 40k for dwellings, and it might be more than one dwelling, if it was two at 25k, then ADS could come into play. And if you're an individual, it's if more than one dwelling or interest in a dwelling with a value of 40k or more is owned at the end of the day of purchase. And of course, it's not just you as the individual that counts. You have to take into account family members and so on. Of course, as we've seen, if there are 6 or more dwellings as part of a single transaction, then there's no ADS. And the other situation is where a main residence is being, that says reclaimed, a main residence is being replaced. Just as a first elephant trap, where it's a company that's buying a dwelling, the company will always pay ADS. It doesn't matter that they only own one dwelling. So companies and other non-natural persons, it's not a counting issue. Any purchase of a dwelling will attract ADS. So the replacement of main residence relief, on the next slide, we can see the broad outlines of it. So if you buy a new main residence and you sold your former main residence within the last 18 months, and it was occupied as a main residence at some point during that 18-month period, then it will count for the replacement of main residence relief. And similarly, if there is a purchase of the form of a new main residence, and then the former one is sold within 18 months, you can reclaim the ADS that's paid. So a few of the elephant traps, the star-crossed lovers, and we've actually had a question about this. Sam and Emma live together in a flat owned by Emma. They're going to buy a new house in joint names and to sell Sam's flat, which has been used as buy-to-let. They know that there's been a change to the rules so that people buying in joint names where they lived in a flat that was only owned by one of them is now okay for ADS, but unfortunately in their case, they've lived in the wrong flat. So they've lived in the flat that Emma owned, and they sold Sam's flat. For the replacement of main residence relief, you have to have lived in the flat that you're selling. So they need to have lived in Sam's flat, if that's the one that they're going to sell, or if they're not going to sell that one, they need to sell Emma's flat. So you need to have lived in the flat that you're going to sell. Occupation of main residence, we've seen this coming up a lot in recent times, and it's a question of having to have lived in the main residence that's being disposed of at some point in the 18 months before the purchase of the new main residence. So in the facts in this case, Bill's selling a flat in Aberdeen where he used to live and buying a new flat in Edinburgh, but the purchase of the Edinburgh house completes before the sale of the old one, so he has to pay ADS. When he sells the Aberdeen flat, he thinks he'll be able to claim the ADS, but he last lived there 3 years ago, so he won't be able to. The 18 months test for when you last lived in the flat is one that's overlooked a lot. A point which we've come across a few times recently is needing evidence of occupation of a main residence. So when you try and reclaim ADS, you need to give evidence that you have occupied the property as your main residence. And that can be council tax bills, change of address, back the bank or similar. And if you don't have that kind of evidence, Revenue Scotland may refuse to repay. So in a situation where people are buying a house together, move in beforehand for a few months, the person that's moved in for a few months hasn't got evidence of having lived in the house together with the partner, and because they were only going to live there for a short time. So I think the moral of that one is to make sure that you do have the evidence. I'll just hand back to Bob to finish off on the final couple of elephant traps before we move to questions.
Okay, so the next elephant trap, I mean, we've called this inherited property, but it can work in a number of scenarios where really what trips you up is having a low value interest in another dwelling. So in this example, Janet and John buy a house for 250,000. The LBTT is 2,100. Let us assume it is their first purchase. And because the benefit of first-time buyers relief is roughly equal to the cost of claiming it, they haven't claimed it. Although they're first-time buyers, they will probably wind up paying the ADS here, because Janet also owns a 1/6 share in a holiday home. The holiday home's value is 120,000 and Janice's share is worth 20,000. I think most people are of the view that because Janet's share is worth 40,000 or less, or below 40,000, that threshold isn't crossed and therefore the ADS doesn't apply. Unfortunately, it does, because jointly owned property, you look at the value of the property as a whole, not the fractional interest someone has in it. So Janet could own 1/10 or less and she would still be within the charge to ADS. So that results in an extra 10,000 being 4% of 250,000 falling due. Another area where we see an awful lot of problems is couples divorcing and separating. So let's say Janet and John separate, John moves out of the home. The normal rule that spouses are treated as a single economic unit doesn't apply, and so anything Janet owns, John is no longer treated as owning, and vice versa. But the matrimonial home, still in joint names, is owned by both of them. And so if John buys a new property while he still owns a share of the matrimonial home, he will pay ADS on that new property. The only way John can get round that really is by disposing of his interest in the matrimonial home. And remember our time limits. He has to either do that before he purchases somewhere else, or he really has to do his purchase within 18 months of moving out, because Once he gets beyond that 18 months point, he's no longer lived in the matrimonial home as a main residence within the relevant timescale. So disposing of it after a purchase does not entitle him to a recovery. That 18-month timescale, obviously very tight. Okay, on to questions.
So we have one question on, is there a specific length of time that someone needs to stay in a property to treat it as a main residence? There isn't. I guess the legislation says that you need to have been occupying it as a main residence at some point during the 18-month period. So there isn't really a specific length of time, but it needs to be more than sort of 5 days. It probably needs to be a few months before it would hold water, and you do need evidence. As we've said, if you're going to make a repayment claim to claim back ADS, or indeed if you need it in reserve, you need to supply it if you're making a repayment claim, but you need to have it in reserve if you're just not paying the ADS in the first place.
Another question which we've answered in the chat, but just worth picking up on, a couple owns a flat each. So Mr. A owns flat A and Ms. B owns flat B. They live in flat A together and are buying a new house. Flat B has been rented out for 1 year, prior to which it was occupied by Ms. B. If the couple sell flat A, their main residence, when they buy the house, and keep flat B, is ADS due? And the answer is no, it shouldn't be, provided really that either the house is bought by Mr. A in his sole name or by A and B together in joint names. That should be fine. But note the point about evidence that Isobel was made.
An interesting question on what would you suggest is the best way of establishing if land is residential or non-residential? Quite a wide-ranging question. As Bob has said in his talk, it's really a question of being able to demonstrate whether the land has a functional relationship with the house, and clearly thinking about whether it's being used for some other purpose, and whether it's in the amount of the land is commensurate with the type of house that it's attached to. So there isn't a single best way, but quite a few different approaches that all need to be brought to bear, really. We've had a few more questions that we're probably not going to have time to answer, unfortunately, because we've pretty much come to the end of the webinar, but we will try and follow up with people if you've left your name on an individual basis. I think perhaps one final point is, if there's a huge amount of land, is that automatically going to be considered non-residential? What do you think, Bob?
No, I would say 27 acres is a huge amount of land, and that didn't work in Pencefold. But as you said, it will really depend on the house that you are buying with that land, and the layout and the relationship between the house and the land, how it's been used historically. I would say that a huge amount of land is almost certainly going to be very helpful, because the more land there is, the more areas of land you might be able to find things that break the functional relationship with the house.
And with that, we'll have to leave it. Thanks very much for coming along to the webinar today. We will be sending out a recording, and as I say, we will get in touch with answers to the questions that we haven't been able to deal with this morning. Thank you.
Thank you.